Hey everybody, back with another dividend analysis, and today we're going to be looking at Leggett and Platt Incorporated, or simply Legg. Wanted to take a look at them because this is another older, relatively mature, well-established company whose ticker has been a bit beat up over the last few months, so maybe we can find a relatively safe dividend at a bit of a discount. And speaking of the dividend, we will start there, currently sitting at a bit over 3.5%, so not too bad. In today's market, dividend yields are hard to come by, so anything that's getting up towards 4% is pretty good, and you're doing much better than the wide market, than the S&P, doing over twice what you'd be getting if you were just invested in something like SPY. Going back over the dividend history, we can see that in 2013 we would have been getting about 30 cents a share, while currently we're getting about 42 cents a share. Now, while that doesn't seem like much, we have been getting increases every year in the form of 1 to 2 cent increases, and after doing a bit of digging, that isn't too hard to do, Leggett and Platt has raised their dividend every year for 50 years, making them a dividend king, as they are colloquially called. Dividend aristocrats are 25 years. Once a company has raised its dividend every year for 50 years, they are a dividend king. So you can take some solace in knowing that you are probably going to get a dividend every year, even if it's very tiny. Companies do want to maintain that aristocrat or dividend king status because it puts them in certain ETFs, it makes investors feel very safe putting their money into that kind of company, things of that nature. But let's see if they're going to be able to keep raising that dividend or not. Heading over to the financials, we can go over to free cash flow, and starting with our ratio of free cash flow, we can see that of their $536 million in free cash flow, we are going to divide $224 million in dividends, which is what they will be paying over the next 12 months if they maintain their current dividend yield, even though it's probably going to go up slightly. We get a ratio of 42%, so very good there. Under our ideal range of 50%, even if they did suffer some free cash flow losses. For example, if this 536 fell down to, 500-ish, they'd still be able to pay it with a good bit of room to spare. It is noteworthy that their cash flow has been a bit spotty over the last 5 years, some big drops here, but it has recovered and made new highs. If I was looking at this, I want to make sure that this is a trend that's going to continue. If, say, we went up $12 million over the last year, are we going to be able to get another 12 million or 20 million in free cash flow in the next year, and so on and so forth? Or is this up and down in free cash flow going to be something that happens a lot in the near future, because that could affect the ability to pay the dividend? Now, heading over to the income statement, if I can get there. There we go. Looking at their net income, we can see it was at $247 million last year, giving us a ratio of income of 90%, which I'm sure all of you know is very high. It's well above our acceptable range of 75%, so there are some issues there. However, we can see that their income had trended down slightly over the last 5 years, so had they been paying out this $224 million in dividends last year, it would have been a lot safer. They would have been under that 75%. This last 12 months is quite a down year. I would want to go into that. I want to see, why is their income so low? Why is it half of what their free cash flow is? Are they doing something? Are they writing things down? Stuff like that. Is this going to be something that continues going forward, or is this just a year that was kind of, just kind of happened? Are they going to get back up to 300 million, maybe 350 million that we saw here about 5 years ago? Those are things that I would be looking for if I was looking at this. Now, how is Leggett and Platt making this money, this income, this free cash flow? Most people know them because they are a furniture manufacturer and they distribute to retailers. They also manufacture flooring as well as steel tubing and a few other things. So this is mostly a consumer discretionary with a bit of industrial mixed in. So a good bit of diversity there. Their business does a few different things. They're getting cash flow from a couple of different sectors. This is the kind of company, though, where if the economy took a big downturn, things like flooring, things like furniture probably aren't going to do particularly well, so you might see quite a bit of a downturn in this stock. This isn't a consumer staple like a lot of the stocks I look at, so just keep that in mind if you're looking at this particular ticker. Now for the big question, should you be buying this, or if you should, who should be buying this? From the appreciation side, of course, something that's a dividend king, 50 years of increases is going to be very attractive to dividend appreciation investors. Getting that 1 to 2 cents a year increase doesn't seem like much, but if you're holding this, forever, over 20 or 30 years, that yield on cost is going to go up by quite a bit. really possibly doubling. If you're holding this for 20 to 30 years, you might be getting twice what you got when you first got in dividends to what you're getting at the end of when you're holding it. But yeah, small yearly increases. If you are a dividend investor, this is what you love to see. Appreciation, a company that's very, very slowly but very steadily increasing that dividend, giving the investor more bang for their buck over time. If you're a dividend appreciation investor, this is definitely something to look at. If you're an income investor, this isn't bad. Looking at their yield at close of business today, about 3.75% isn't bad. It's not the highest in the world, but you're doing a lot better than the wide market. Again, this is a large, relatively mature, or should say relatively large company at $6 billion. It's not a small cap by any means. It's very mature, over 100 years old. There's going to have to either be mismanagement, or the company's really going to have to, their sector, either someone else is going to have to come up and take their spot, or something's going to have to change in the things they produce for them to really go out of business. So, if you're looking for something that's in, those consumer discretionary kind of sectors, things like that, this might not be a bad idea. Almost 4% isn't ever bad, and especially in this market where it's really hard to find yield, especially relatively safe yield or yield from relatively well-established companies, this doesn't look too bad. Now, at its current price, $45, it's really hard to say. Currently sitting at a 15 PE, we can see that really it only ever gets up to about $55. Beyond that, it's this 40-ish dollar range looks kind of good. If you were just dollar cost averaging into this, maybe buying a share a month for the next few years, this might be fine just going in at 45. Myself, I really like to get things on a steep discount. I'd really like to see this get around this $40 range. If you can get below that, back where it was during the crash or beforehand, under $40, that would probably be even better. But if this is just something you're looking at to, I have an income portfolio, I'm looking for another ticker for diversification just to add in every month, this might not be a bad idea. Aside from that, yep, seems like an okay company. Definitely no huge glaring issues, no big debt problems. Their cash flow more than covers their dividend. They don't seem ridiculously overpriced. There's no 10 times or 100 times valuation here because this is such an old, boring company. So yeah, definitely something to look into both from the appreciation and the income side. And as always, I hope this helped, and thanks for watching.